Before this index had traded a single point up there, the options market had already told you where today would stop. 74.96 and 04. Nobody tweeted that number. It falls out of what traders were actually paying. And it was sitting on our desk at 10:19 this morning, 1 minute before price first reached it. Then the session spent 5.5 hours proving it right. 10:20. High of 74.98 and 43. 12:55. 2 hours and 35 minutes later. High of 74.98 and 47. 0.04 of a point between those two prints. 7 different bars pushed through the line across the day. 77 bars traded the session. Not one of them closed above it. AlgoIndex market close. Friday, the 17th of July. The index gave back 38 points from that ceiling. Settled at 74.57 and 69, down 1%, on the exact day that ceiling expired. 4 questions, and we answer all of them. Who pays 140% implied volatility for a strike 21% away, and then does it 3 weeks running? What does somebody buying a butterfly centered on a fear gauge print of 40 know about August that you do not? Why did a monthly expiration pin, the strongest mechanical pull on the board, miss by 62 points? And which of the 4 calls we made on this show last night do we not get to claim tonight? The index closed at 74.57 and 69, down 76 and change, 1%. The Nasdaq lost 1.5%. Semiconductors fell 2.18% and did the steering again. The fear gauge closed at 1876, up 12.2%. The measure that prices how violently the fear gauge itself can move closed at 104.87, up 7.77. The whole day fit inside 89 basis points. The low, 74.31 and 26, came at 9:40, 10 minutes after the bell, never revisited. Puts outtraded calls 1.54 to 1. 1.17 million puts against 758,000 calls. And the reading almost nobody checks on a day the fear gauge jumps 12%. Implied volatility closed at 14.95. Realized volatility, what this market actually just did, was 15.11. Options finished marginally cheaper than the movement they exist to ensure. 3 forces, each with a number. Leadership first. The semiconductor group fell 2.18% and took the market with it. Micron alone traveled about 11% intraday, up off support near its 800 strike, then stopped cold at resistance near 900. And almost all of that was traded in options expiring the same afternoon. Second, the flow, and it does not agree with the headline. Index hedging flow finished the day at minus 1.6 billion in delta notional. Break it open. 2 billion of that was put buying. 1.4 billion was call buying. Both sides were bought, in size, against each other. That is not a market getting dumped. That is two-sided accumulation wearing a red number. Then set the Nasdaq beside it. Nasdaq flow closed at plus 4.3 billion, and the majority was longer-dated call buying. Read that twice. The index that fell furthest today attracted the most constructive positioning of the session. Somebody spent real money on technology upside. On the day, technology was the reason everything was red. Third, the ground underneath. We closed below the dealer gamma flip level at 74.90. And beneath that line, hedging amplifies a move instead of absorbing it. That did not start today. As of last night's reading, this index's net gamma had already gone negative for the first time in 13 sessions. The cushion was thinning before the week ended, and today's expiration took away what was left of it. Now walk the session against that number, because this is the whole story. 9:35. The index opens at 74.47 and 52. 5 minutes later, it prints the worst price of the entire day, 74.31 and 26. And that is the last anyone sees of it. 10 minutes in, the low is already behind us. Then it climbs into the line. 10:20. First contact. 74.98 and 43. 10:25. 74.96 and 19. 10:30. 74.97 and 09. 3 touches inside 11 minutes. 3 rejections. 12:05. Again. 12:55. The high of the day. 74.98 and 47. 1:05. Again. 7 touches. Deepest penetration, 2.5 points, and it survived less than 5 minutes up there. 16 separate bars printed a high within 3 points of that line. 0 of 77 closed above it. Not 1 minute of accepted trade on the other side. Here is the part that should bother you, and it is why tonight matters more than most Fridays. This was a monthly expiration. Expiration's pin. The drag toward maximum pain is supposed to be the heaviest mechanical force in the building. On this show last night, we published the index native pin at 75.20. The morning's fund-based estimate put it around 7,500. We settled at 74.57 and 69. 42 points below the nearer pin. 62 below the other. On the single day of the month when that pull is supposed to win, it lost. And nothing came to drag this market back up to either number. The clean map. Ceiling that held every attempt. 74.96. Gamma flip level, 74.90. The decision line their morning red published, 74.80. Close, 74.57 and 69. Support shelf beneath it. Today's low at 74.31 and 26. Every one of those numbers except the close was knowable before the market got to it. Tonight, the long look goes on positioning, because 2 of these are worth your weekend. Start with the one that looks like a lottery ticket and is not. Somebody bought 68,484 calls on FIG. The stock that closed at $24, struck at $29. About 21% away, 1 week to expiry, at 140% implied volatility. On its own, unremarkable. Here's what makes it worth naming. It is the 3rd time. Roughly 57,000 of the same idea showed up at the July 17th strike 4 sessions ago. And instead of letting them die tonight, they were rolled forward into next Friday. 3 times now, the same 1 week, 20% away bet on the same name. Nobody rolls a lottery ticket. Now the other side of the barbell, and this is the structure of the night. Somebody built a position in the fear gauge for August expiration. Long about 53,600 of the 25 calls. Long about 54,400 of the 55 calls. Short about 100,700 of the 40s. Sitting in the middle, paying for both wings. 1 by 2 by 1. A butterfly, centered on 40. The fear gauge closed today at 1876. 40 is a move of more than 110% from here. That is not protection against a rough week. The maximum payout on that structure lands at a level this market only reaches in a genuine dislocation. Somebody has put on defined risk, with a month to run. That says this market breaks before August 19th. Underneath it, 48,000 small cap puts, bought to open across 2 strikes. No ambiguity at all about what those are for. 2 qualifications, because you should not swallow any of that whole. First, the percentiles. Every extreme ranking in that report, including the 0 percentile bond readings its own summary calls extreme, is measured against the last 10 sessions. Not the last year, not ever. 10 days. 0 percentile means lowest in 2 weeks, and if nobody hands you the window, the word extreme is doing work it has not earned. Second, the one we cannot settle. That report's model reads bond positioning as the most bearish thing on its board. The single largest bond print inside the same report is 219,797 calls, bought to open. A call purchase carrying a negative delta reading is consistent with how the dealer ends up on the other side of it. It is equally consistent with the model and the prints simply disagreeing. We can tell you precisely what changed hands. We cannot tell you tonight which of those 2 explanations is right, and we are not going to choose the one that makes a better sentence. Quick one, then the desk. Implied volatility rank closed at 27.35%. Last night, it was under 17. So the price of protection jumped hard today, and it is still only 27% of the way up its own 1-year range. But read the number sitting next to it. Implied volatility percentile, 66. 2/3 of the last year's sessions closed with cheaper options than tonight. Both readings are correct. Low in the range, expensive against the typical day. That gap tells you the range is defined by a handful of panics, and that we are nowhere near one. 25 delta skew closed at minus 0.052. Puts bid over calls, the way they always are, by an unremarkable amount. Net of it, this market repriced fear today without paying up for it. Protection here is not expensive. It is ordinary, heading into a weekend that is not. Our own desk. 3 wins, 1 break-even, no losses, and 2 ideas that never filled at all. The automated strategy took both entries and hit both targets. The first went in at 75.04 and a quarter and reached 75.16 and change. 12 points. 7 member accounts exited inside 1 second of the signal. The discretionary side is where the honesty is. 4 ideas. The first never got approved, and the condition that would have invalidated it triggered while it sat waiting. So the delay saved a losing fill. The second armed, and then voided itself automatically, when price reached the target before the entry, which is the system refusing to chase. The third filled and got closed by hand at -2 and a quarter. The fourth filled and got closed by hand at +9 3/4. Net, +7.5 points. Nothing red. And now, the part worth more than the score. Both of those exits were manual. Both came before the target. And both times, price went the other way immediately afterwards. The third closed at 75.25 3/4. And within 7 minutes, the market was at 75.11 3/4. The fourth closed at 75.07 3/4. Price stretched to 75.11 1/4. Then fell to 74.87. Twice in one session, the hand beat the arithmetic. The stated reason was that it was Friday, and there was a profitable week on the member book not worth risking. The lesson we wrote down at the bell was this. On a session shaped like today, the question was never how much. Monday. Scorecard first, because we promised you one last night, and it does not flatter every row. 4 calls went out on this show for today. 4 verdicts, and they are not all the same shape. 1. We said everything carrying real probability sat lower than the close. The index fell 76 points. 2. We told you the 7,500 position propping this market up dies with today's expiration. It did. We finished 42 points beneath it. That lands, and it is the row that shapes Monday. 3. We told you both expiration pins sat underneath us. They did. And the market went straight through both and kept walking. The direction was right, and the mechanism was wrong, because we implied those pins would pull. Neither pulled. 4. And this is the one we do not get to claim. Our words last night were that under 74.80, dealer positioning turns hostile, and the hedging itself drags this index sharply lower. We closed under 74.80. The session lost 1%. 1% is not sharp. The line was crossed, and the consequence never arrived. A trigger that fires and delivers nothing is a trigger we described wrong. And taking credit tonight, just because the market happened to fall, would mean grading ourselves on direction, while quietly deleting the adjective. Now Monday itself. Maximum pain for the next expiration, computed on the index, sits at 75.25. 67 points above where we closed. Separately, the strongest magnet strike in tonight's options read is 75.19. 2 different methods, 6 points apart, both putting the gravity above this market rather than below it. Set against that, we open beneath the gamma flip level at 74.90, which makes hedging an accelerant until it is reclaimed. Both of those are true simultaneously. That is Monday's tension, and anyone selling you a clean direction out of it is guessing. The map reclaims 74.90, and the pull towards 75.19 to 75.25 opens. Lose 74.31 and 26, today's low, and the next shelf is 74.15 to 74.26. The week ahead is where the size lives. Alphabet and Tesla both report Wednesday, both priced for roughly 6% moves. Texas Instruments, about 9. ServiceNow, about 11. Intel, about 13. The economic calendar is light. The earnings calendar is anything but. And the honest one. The house view we track has argued for a week that every ingredient for a sharp correction is now present. And the only missing piece is a trigger. And it named a Middle East escalation as one candidate. That situation escalated overnight into this session, and it goes into a weekend unresolved. We are not forecasting anything from that. We are telling you the thing most likely to set Monday's open is not on any chart tonight. And it happens while the market is shut. That is Friday. That is the July expiration. Nearly every number in the last few minutes came from data most traders never get to see. Our journal costs nothing. Feed it a trade, and it scores that entry against whatever levels were genuinely live at the second you pulled the trigger. members.algoindex.com/auth/signup. Our level record stays public, whether it flatters us or not, And that is the only reason a scorecard like tonight's is worth listening to. Everything we forecast, graded, at algoindex.com/tools/gamma-level-accuracy. Tonight's numbers go up in writing at algoindex.com/blog. Here is what I am watching, and it is not a price. Every level we just walked through expired tonight. Monday's map gets rebuilt from scratch, on a market that closed under its own flip level, with a geopolitical situation running loose through 2 days when nobody can hedge a thing. The first hour Monday owes nothing to anything we published this week. Go and have your weekend. We will find out together what it built.